Hey, what's happening all? It is looks like Friday the 15th, and I am out just outside of Moab. You can check out this really cool background. You got a we're got a youth group that's out here on the river, and they have me just kind of keeping an eye on stuff. So I'm operating off my Starlink, which is kind of cool, right? So I'd ordered the Starlink for the house, I'd ordered the Starlink for the cabin, and then I got an email that I could do the one for the RV. So I got my Patriot X3 trailer, I've got the Starlink set up, you can hear the generator running in the background, and it's awesome. So we'll see how well this works out. I'm praying it works out really well. So kind of, man, it's been a wild week while I've been out. We got the June readings that came out on the 13th of this month, which we saw year over year inflation raising from 8.6 to 9.1, which is pretty interesting because before we saw the 8.3 go to 8.6 and everybody freaked out. The market completely went crazy. Now we went from 8.6 to 9.1, which is even bigger move, right? That's a 0.5%. And it wasn't as big of a move, but we saw a big move that day, but it all crawled back by the end of the day. So it really wasn't something that hurt us that bad, right? Rents had a big increase. We saw a 0.8% increase, nearly 1% month over month there. So then we got a year increasing year over year. Energy prices went up at 7.5% from a month before, right? So from the May reading to the June reading, 7.5%. Which brings an annual increase on energy to 42%. Gas prices up 60% year over year. Guys, it ain't all about Putin. And if you're thinking otherwise, you might want to get your head straight on that one. Food costs up another 1%, which is a year over year increase of 10.4. So we're thinking with all that's going on, the Fed's going to get at least a 3/4 bump in the federal fund rate, maybe 1%. The other thing that we're seeing is the yield curve continue to flatten in the Treasury. So what does that mean? It used to be the 10-year would pay more money than the 2-year or the 1-year, right? Because the less time you have it, the greater chance you're getting paid back, you're going to make a lower return on it. Well, now the longer the money is being held, the less money it's being making. People are making more money, more yield, more return on a 2-year bond, or now even the 1-year bond. It's gone what they call a yield curve is inverted. That inversion comes usually in a recessionary era or a recessionary environment because of one, this inflation. Nobody wants to have their money sitting out there that long. So we're really amazed that interest rates on loans, on mortgages are staying as good as they are. The producer price index came out yesterday, which showed wholesale inflation raising another 1.1%, right? Which brings year over year 11.3%, right? That right there is causing a lot more increase to the cost of goods, right? So your people providing goods is going to either reduce their margin or increase their prices. Scotty just when I was just talking, he's run restaurants in the past. Ketchup, just Heinz and stuff going up over 30% is what they're increasing their costs because they can't just keep dropping their margins. They got to increase their cost to you, right? They got to pass that on. Interestingly enough, we have maintained our margin and our cost to you pretty much ever since I started this team. The only cost I've increased was my the upfront fees. They went up by $24 since 2015. That's it. We're trying to keep that low for you, trying to be more efficient. But there's wage inflation, all these things that we got to deal with. That just it's going to be tougher and tougher for anybody to be able to continue to maintain their margins and still be able to provide a quality product. So just know that is going to lead to more consumer inflation. The freight index came out, and it says the cost of shipment of goods has contracted by 4.1%, meaning they're not moving as much in shipping because of all the cost to ship. As a result of that, pushing more into a recessionary area, then you've got initial jobless claims. Interesting. They increased by 9,000, right, to 244,000 initial jobless claims. That's kind of like, the story of the canary in the coal mine, right? They keep the canary in a cage, and if the canary dies, there's something going on there. You got to get out. That's thought of as a canary in the coal mine for the market, the wage market starting to soften, or the jobs market starting to soften. So a lot of things going on out there. A lot of things. There's something else you want to be aware of. As you hear about people doing non-QM loans, getting outside of the conventional lending, you're talking about, when you go beyond your 10 finance properties, that's going to start seeing some possible increase in rates. I don't see why it won't, right? I've been reading some stuff and watching some videos. Sprout Mortgage just went sideways, right? I think 600 plus people out of work, and there was thousands of loans that have just been thrown out there to the people who put up the money for the loans, the investors, the people who extended credit to the company. right? And because of that, that's greater risk to them. They may not want to do more of those kind of loans. So as a result of that, it could increase the rates on those types of deals. It's kind of sucks. So let's get over to the charts here and take a look and see what we've got to share with that. In fact, I got to change a couple other screens. Let's see here what happened to my charts. This ain't good. And I'm not going to stop this because if I've got things working, I want to make sure that I keep it going. Plus, there's a glare here. It's kind of hard to see. So, oh, here we go. I think I've got my charts here. Not. Here we go. All right, there we are. So, what we see here, as you can see, just here's see this big dip we had here. That was when the inflation numbers came out. We hit the support, came up off of it, maintained it when the producer price index came out. And here's today. We're standing right in the middle of this channel. So typically with technicals like this, you want to float to the bottom. We want to lock at the top, float at the bottom. So meaning lock up here. When it gets down here, you want to hold out and see if we can get it to come up here. In the middle, it's just kind of a lock or float situation, depending upon your needs. I just say, since there's no real rhyme or reason for how the market's going to play out, are we going to stay in this channel or are we not? I'm more going to say we just lock when you're in a spot to lock. Because we're in a rate environment that we shouldn't be at. It should be much higher. If you look at the last video I put out, the rates should be significantly higher when you just look at the averages. So that's where we are today. I'm going to get you more information on Monday, but that was a lot to hit you with. I know it's a ton, but rewatch it, understand the data. I'm just surprised our rates are as good as they are given all that inflation that we've got. So it's a good thing. It's a very good thing for us. Take advantage of it while you can. Talk to you guys on Tuesday.